The subject of accounting is linked to a number of other subjects, for example, law, auditing, tax, etc. But in the concept of accounting, we distinguish two types of accounting, and that is management accounting and financial accounting. In this presentation, we will show the difference between management accounting and financial accounting, where both of them are used, and maybe one or two examples of where they look at terminology differently. Management accounting is where the management accountant identifies, measures, analyzes financial information for management purposes, so that management can look at it in order to make decisions that will help them to achieve the company's goals. Generally, management accounting is internally based, so we analyze all of these financial information and events in order to assist management, internal management, to make well-informed business decisions. On the other hand, financial accounting also goes to record, summarize, analyze, and report on transactions that have resulted from business operations over a period of time. These financial transactions are then summarized, but they are summarized in a way that they can be useful for external stakeholders, users, parties, to make decisions about the business. So it doesn't so much affect how the business is managed. It is an assessment of how the business was managed, and to an extent also the strength of the business and the future prospects of a business. So if management accounting is looking inwards, providing information to managers to make decisions, financial accounting is summarizing what has happened in order to provide information for economic decision making, but maybe even outside the company, not only inside the company. The product of financial accounting is the primary statements that we know about: the balance sheet, income statement, cash flow statement. Nowadays they are known as the statement of financial position, the statement of profit and loss, and the statement of cash flows. And then together with that goes some explanatory notes, accounting policies, what methods we used for inventory, some items that are not on those statements like contingent liabilities and other material line items. They will all be in the notes. That's the output product of financial accounting. Financial accounting uses various established principles, standards, legal requirements as a method of summarizing the financial information so that it can be useful and so that it can be consistent. It's very important that it's consistent, because you must be able to compare financial accounting results from year to year and from entity to entity. In South Africa specifically, the regulations are found, or the legislation found, in Section 30 for companies. Companies Act 71 of 2008 determines the requirements for the preparation and presentation of financial statements, specifically annual financial statements, and that has to be read together with Regulation 27 of the Companies Act that determines the frameworks that they're allowed to use, let's say the rules that a company is allowed to use in order to prepare its financial statements and thereby achieve the consistency that we talked about. Just to highlight one difference between management accounting and financial accounting would be if we could look at the cost of inventory. If we value inventory, financial accounting makes use of an accounting standard. In the case of, if we use International Financial Reporting Standards, it's a standard called IAS 2. We will use IAS 2 to determine the value of inventory. Different frameworks have different standards, but IAS 2 is by far the most common one. That is International Financial Reporting Standards. That is for financial accounting. That's for external reporting purposes. For management accounting purposes, the cost of inventory can be determined by using different methods. We have a method called variable costing, where you only allocate the cost of producing one widget to that widget. We have a process called absorption costing, where you absorb some of the overheads into the cost of inventory. Activity-based costing is what it says. Process costing, job order costing, standard costing is a method to approximate one of the other costing methods. If it comes close, then you can use standard costing. So these are different methods that management use in order to allocate costs to their inventory so that they can make decisions. It's not necessarily what is used for external reporting purposes because it may not be consistent across industries. Maybe the rules are not so clear. So if we report outside, then we use the accounting standard IAS 2 to determine the value of inventory. Management can't really decide exactly what they want to use. They have to go within the norms of IAS 2 when they want to report externally. For financial accounting purposes, you may value inventory at the lower of cost and net realizable value. So you calculate the cost of the inventory and you use that for cost, except if the inventory is going to be sold at a lower value, then you use net realizable value. And then there's different ways of valuing. You can use FIFO, which is first in, first out, or weighted average, or specific identification. There's different cost formulas that can be allowed. But basically, the International Financial Reporting Standards are a little bit more restrictive as far as models are concerned than what it would have been if the financial information is only used for internal purposes. So more differences between management accounting and financial accounting, and we have mentioned some of them already. Management accounting, internal, managers, plan and control an organization. Financial accounting is for external people who make financial decisions depending on those financial information. Time, management accounting is more looking at future, what can be produced, what will it cost us, what are we planning to produce, whereas financial accounting is looking back, looking at what have we achieved and where are we now as a result of that, not really looking forward. That's not the prime emphasis. Frequency of reporting, financial accounting is prepared on a periodic basis, definitely at least on an annual basis, because the Companies Act and income tax requirements dictate that, but it could also be produced more often. Management accounting is produced where necessary. Management accounting could be on an ongoing basis. Management may be able to press a button at any point in time to see where the results are right now. It doesn't have to be linked to a specific period. The subjects, management accounting would focus specifically on segments, financial accounting would focus on the whole organization. What standards are used, and here we refer to IFRS, International Financial Reporting Standards, or International Financial Reporting Standard for small entities. It's not necessary to follow it for management accounting. As we said already, there you can use whatever works for management, what is useful for them for decision making. But in financial accounting, you have to use what is prescribed by laws or regulations. And in South Africa, it is IFRS or IFRS for SMEs. And the requirement is management accounting you don't need. There's no act that says that you have to prepare management accounts. It's just important for management purposes. And financial accounting is mandatory depending on the type of organization. For example, a company has to do it annually. There's annual requirements for financial accounting purposes. After all of that, it may sound like all of it is about numbers, but we would like to close off with a quote from the RSM International CEO, Gene Stevens, who said, "International accountancy has always been a fast-paced, exciting and rewarding industry, but as technical as it may seem, our industry is also very much a people business.